spoken about the stats. Let's talk about markets, the mutual fund industry, and investments in general. So let me start with you, Meenakshi. Want to understand what is your take on the market right now? We are at all-time highs. There's been a remarkable rally as well that we've been seeing in small caps and mid caps. So do you think the momentum is intact, or is it time to turn a bit cautious?
Yeah, thank you very much, Sonal, and thank you, Pavitra. Very heartiest wishes to all your viewers on Women's Day. Just to coming back on view on markets, the markets have done stupendously well in last 3-4 years, and expecting the similar kind of returns will be overstretching it a bit. But if you just look at earning performance and how the companies have been doing, the companies' growth have been quite resilient. So if you look at earning growth of the broader market, that has been very well. And the good part about this current cycle has been that there has been very broad-based participation in terms of earning growth from various segments in the market. So we remain quite constructive on the market, but coming to the valuations, definitely valuations have gone ahead of what the fundamentals are. But considering the growth environment we are in, I think we, on a medium to long term, we all have to be constructive on the market from here as well.
All right, got that. So, Meenakshi, tell us right now, where do you think you're finding opportunities? Considering that the markets have run up so much, specifically the broader markets, do you feel that there are some pockets where you still feel comfortable putting in fresh cash?
See, Pavitra, we have to zoom out a bit. Considering the kind of rally that we have seen in the market currently, we have to now look at what is the medium to long-term growth prospects of various companies and various sectors. So if you look at private capex in India is picking up after a very long period. So if you look at the policy framework that has been laid in place, if you look at the kind of opportunities that private sector is seeing currently, and on top of it, if you see the kind of balance sheet strength that these companies have and the kind of growth capital that they have been able to get from the listed space, all these things still point to a very healthy growth rate in these segments. So these segments can be, PLI schemes, which have been rolled out in electronic sector manufacturing, or you can have renewable, new energy. All these are structural long-term themes. So even if the near-term valuations are a bit higher than what the fundamentals are, but from medium to long term, they still can give you good amount of returns.
Okay.
And in terms of public sector, that thirst from government in terms of public sector spending continues. So if you look at the recent budget also, that trajectory is on track. So if you look at railways, defense, and allied industries, they still point to a growth rate which can be higher than the last decade growth rate. So anchoring it to valuation of what it was in last decade will be also wrong for the investors.
Okay, we take that point. So that's about equity investments and sectoral update in general. But let's talk about debt now. And Anju, let me come to you for that. The conversation globally has been a lot about interest rate cuts. So how do you read the debt landscape in that scenario?
You rightly said, the interest rates across the globe have peaked. We are all in a scenario. We all know what influences interest rates is growth and inflation dynamics. Inflation and growth dynamics are both in favor of lower rates going forward, and we are gradually seeing growth across the globe moderating. Inflation also is showing softening stance, which was at its peak a few months back. So both all central bankers are now looking to cut rates, but the timing is yet to. They are still not comfortable as on date to cut rates, but the direction is basically rate cut, but the timing we all don't know, and depending on how the numbers come in, both of inflation, growth, and other macroeconomic numbers, we will see rate cuts in 2024. First, Fed may cut, and RBI will either around the time or may follow rate cuts from India perspective. So one thing is very clear: we are in the downward. Rates are supposed to cut. Will come down from here onwards.
Okay, understood. So that is the debt landscape as we see it. Anju, another theme that we were discussing just last episode was passive investing and how it's really catching on in equity funds. SEBI also now wants to try and push this category. Are you seeing a similar trend that, in the debt category as well? So basically in the target maturity funds, do you think there's a similar trend playing out there? And do you think that there are measures required to push the passive debt space?
Passive debt space was quite in favor till 2023. We all know taxation changes came for debt funds, and that made passive investing more competitive. Your other traditional products which are available in the market have become more favorable to, because we are at par with them from taxation perspective. Earlier, investors used to choose passive investing or debt products more for taxation than for anything else. This has changed right now. Now passive investing is broadly like target maturity fund. You are saying they compete very much with traditional other investments like fixed deposit or corporate FDs or whatever other instruments that are available, where there is a certainty of rate what they will get. But as we give market related returns, naturally we are not able to give any number to our performance. So now post taxation changes, they have lost in flavor, and new products are also not launched, and neither very large flows is coming in these segments. And with regard, when you compare with equity, also if you see the expense ratio of equity funds, which are actively managed and passively managed, is very different, and the differences are quite large. But for debt funds, if you see, the actively managed funds are equally very competitive in expenses and passive. So hence the differential is very low. So naturally, people look to invest more in actively managed fund than just flocking towards passively managed funds.
Makes sense.
I would say,
yes, please go ahead.
Yeah, I would say passive funds, though are available in the market, but they don't give any additional benefit to the investors other than some certainty of returns which may derive from the portfolios and the data available.
Okay, totally makes sense, and thank you for that insight. Let's go across to Kinjal now. You look at global markets. So what stands out to you in global markets now? We have seen Nvidia blowing up in the US, but we have the Chinese market which have corrected big time. So what according to you is looking good from an investment standpoint?
So thanks so much for having us here. I would say that, we've seen the US markets per se. They've done quite well in the last 1 year, and the fundamentals also are quite supportive. However, on the other hand, the valuations are definitely on the higher side. The other part is with China. China, we've seen has had a rough 3-4 years, and there also the valuations kind of suggest that most of the negatives do seem to be on the more supportive end out there. I would say that both these markets, combination thereof kind of makes sense, from a 3 to 5 year perspective.
Okay, understood. Kinjal, with okay, I think there was some trouble with that audio, but I can hear you again now. So, Kinjal, you look across the international space. You have a Japan equity fund, you have the US equity opportunities fund, and the Hang Seng ETF and the Taiwan equity fund. So, within the offerings that you have, if someone is to invest right now, they want to take some international exposure. Which of these seem better positioned right now to you?
So I would say that again, US and China combination kind of works quite well from a slightly medium-term perspective. Primarily because US is a large market, we can't afford to kind of ignore it, even though the valuations are higher. And China can, kind of be quite supportive. The policy also seems to be supportive on that end. On the other hand, Taiwan and Japan are kind of in the middling. Both of them have been performing very well. We have seen the AI thrust, helping Taiwan a lot, and even Japan, the policy is quite supportive at the moment. The valuations are somewhere in the middle, so maybe a smaller, kind of allocation out there with more towards US and China.
Okay, so we've covered a lot from equity markets to debt to international markets. It's been a very interesting chat, but we have to get into a quick commercial break. On the other side, we'll continue our discussion with all the three guests on the show, and this is our Women's Day special, so don't go anywhere.
Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV18, and we've spoken a lot about, how it is like to invest in equities right now, the outlook for debt as well as for international investing. Meenakshi, let me come to you now. Just last week, we had SEBI saying that they are worried about the big froth building in small and mid caps, and they want mutual funds to come up with some kind of measures to safeguard investor interest because a lot of money has flown into these categories. So I want to ask you, what do you think can be done? Because they've suggested steps like moderating inflows, portfolio rebalancing, which, are pretty extreme measures. It can be a little bit disruptive as well. So what do you think is feasible?
See, when you're an institutional investor, especially investing money of large retail investors, prudence is always advisable. So, what we have done in our funds is that we have stopped the lump sum, and so as some of our peers also. This category requires little more patience because small and mid caps tend to be little more volatile compared to their large cap peers. So a staggered investment or a systematic investment is always recommended. And considering the current valuations that we are in and the kind of rally that we have seen in last 3-4 years in this space, there is definitely prudence required. And other changes, from a regulation point of view, also in this category, see, you also have a lot of space to invest in large caps and companies which are large and liquid in names. So those kind of readjustments we have already done in our portfolio. So as far as we are concerned, I think there is nothing for our investors to worry in this front.
Okay, all right. So that is about the mid and small caps and what's happening there. Let's talk about the overseas scenario. Kinjal, we were just talking about the overseas funds. In your US Opportunities Fund, you have big exposure to the AI theme via Microsoft, be it Meta, Alphabet, Amazon, but no exposure to NVIDIA. Why did you avoid this one? Do you think this was a missed opportunity? Or would you still look at this one right now?
So we can't comment on individual stocks in our portfolio, but I would suggest that AI is a big theme. It has been evolving quite quickly, and we've also seen that the uses for AI are getting more broad-based. So going ahead, we do expect to see a lot more developments in this space, and it remains kind of a very attractive segment overall.
Okay, but you don't look at this as a missed opportunity, and I'm not talking about just you. We did a sort of analysis of all of the big funds in India, the funds which have big AI exposure, and none of them seem to have NVIDIA, which was quite surprising. So do you think as an industry we've missed out on this one?
I'm sorry, we will not be able to comment on individual stocks as of now.
Okay, all right. That is on NVIDIA and on the international exposure. But moving on now to the debt space. Anju, within debt, we have seen a big shift to hybrid and arbitrage funds after, like we were mentioning, the tax changes were announced. Do you think this trend is going to sustain? Because these categories have, of course, become a lot more attractive, since that tax change came through.
As we all know, arbitrage fund are used, have seen good amount of flows in current financial year, which is basically because they have been used as a replacement of ultra short term category, and they are competing, and because of the taxation benefit, they have found favor from among the investors, and hence had seen very good flow. But for hybrid funds, other like BAF or equity hybrid, they all have minimum 65% equity exposure. Because if they have 65% equity exposure, then only they get tax benefit. One should not look at it that this is a replacement to a debt product. This is not a replacement to debt product, but it is a product with lesser volatility and will hence get potentially get lower returns than normally a full equity or a lesser. One would say both sides beta will be lower on both sides. So hybrid funds, I would say, is just an equity fund with lesser volatility. But yes, arbitrage funds are getting good flows because of because they are used as a replacement to our ultra short term category debt funds, and this may continue going forward.
Okay, all right. Meenakshi, this question is for you. I think this is the last one for the show today. This year has seen quite a trend reversal with most mid and small cap active funds not being able to beat the super benchmark returns while large caps have. Do you think passive or smart beta will see a big rise in the small and mid cap space now?
We have seen quite a strong rally in mid and small cap space in last 3-4 years. So in terms of the breadth, that has definitely gone up. The kind of stocks that have participated in this rally has gone up. The retail activity is quite high in this space. So as an institutional investors, it is not advisable and also feasible for you to participate in some of these stocks which have gone up in the recent rally. But for you to take a judgment whether passive investment will become big in this space, I really doubt, because in this space, the importance of research is very high because the information asymmetry is large. So that market efficiency theory doesn't work as well in this space as it works in large cap space. And also because of their size, the kind of float they have, the impact cost of managing a passive fund can be quite high. So I don't think, see, there will be a space for each, but I don't think passive will have any superior advantage over active funds in this space.
Okay, we take that point, and with that we're completely out of time on this edition of MF Corner as well. Thank you all so much for joining us today, and once again wishing you as well as all of our viewers a very, very happy Women's Day. With that, we're going to wind down on this edition of Mutual Fund Corner. Thanks for tuning in. We have closing bell on the other side.